Good afternoon. Chapter 4 is on professional ethics, code of professional conduct. Independence is the big issue here. Independence is the 800-pound gorilla in this chapter. There's a handout available for Interpretation 101-1 in Canvas. Make sure you print it out, at least the first page. It'll make it much easier to follow part 2 of our discussion of chapter 4. Remember, you're still responsible for the definitions of 200, 315, 500, 700, and independence. You're responsible for the assertions. We'll be adding to them in this section. You're responsible for audit reporting. Those things you're responsible for throughout the whole course. I guess professional skepticism also flows through the whole course. This is an article by Francine McKenna. Francine is a bit of a skeptic about the big accounting firms, but she brought up a very valid point. This was from September of 2010. The economy was reeling from all the failures. And she was wondering, who are the auditors working for? Are they working for the investors, or are they working for the banks? In her opinion, the auditors failed to require companies to disclose the risk related to their repurchase agreements. Principles versus rules. The first part of the chapter talks about principles. Principles are ideal standards of conduct. Principles are usually not enforceable. Rules, on the other hand, establish minimum standards. They are enforceable. California has a basic speed law that means you can never drive faster than what is safe for the current conditions, such as dense fog or slippery roads. However, that becomes subjective and judgmental. So we've got these silly little signs all over the roads that tell you exactly how fast you can go. Here's the table of contents for the AICPA Code of Professional Conduct. You'll see there the principles of professional conduct. The book has those same 6 principles: responsibility, public interest, integrity, objectivity and independence, due care, scope and nature of services. I don't really test over the principles. If I do ask on the test, I'd ask you to list 5 principles. So if you know 5 of the 6, you'll get full credit. You can read them as well as I can, so I'm not going through each of the principles. But what I do want to point out is public interest, honor the public trust, integrity, maintain and broaden public confidence. We, as auditors, are totally dependent on public confidence. The report that we sell, the most important paragraph, the opinion paragraph, in our opinion, the financial statements present fairly. If we don't have the public trust, if we don't have public confidence, those words become meaningless. In our opinion, the financial statements present fairly needs to add value to investors. They need to be willing to pay more when a company has that report that says, in our opinion, the financial statements presented above present fairly in all material respects. If we lose public confidence, then we're out of business. Objectivity and independence. This is the definition we are using for independence. Yes, I'm very well aware that it's actually 2 components. A member should maintain objectivity and be free of conflicts of interest in discharging professional responsibilities relates to objectivity. A member in public practice should be independent in fact and appearance when providing auditing and other attestation services. That's independence. But if I ask you for the definition, I want the whole thing, both sentences. Okay. It has to do with how I'm going to teach independence. The first sentence relates to Lindsay when she's doing tax work. Doing corporate taxes, she does not have to be independent of her corporate tax clients. Auditors, on the other hand, must be independent of their clients. The ICPA, SEC, and PCAOB are all sources of rulings on independence. I believe they're consistent. The SEC guidelines regarding independence, they say auditors are not independent if relationships create mutual interest with the clients, create conflicting interest with the client, the auditors audit their own work, the auditor acts as management or acts as an employee of the client, or the auditor becomes an advocate for the client. Now, this last one is problematic because if we do a company's taxes, we may be called upon to become an advocate for the client. So we are allowed, the auditor is allowed to perform an audit. The same accounting firm is allowed to perform taxes. They may, in fact, become an advocate. The SEC and PCAOB are very, very well aware of the situation, and they chose to carve out an exception for taxes. So accounting firms are allowed to do both the taxes for a client and also audit that client. These are 9 services that accounting firms cannot perform for their audit clients. They can perform these services for other companies, but not for their audit clients. So Deloitte could implement a financial accounting system for an Ernst & Young audit client. Deloitte would not be allowed to install a financial accounting system if Deloitte was also doing the audit for that client. Remember, there are multiple other presentations for this chapter.